Okay, some questions from Sunday's market outlook. Where would you long December Fed funds futures IBKR? Yep, the ticker is ZQ. When you type that in, you'll get a menu which gives you some options of what you're looking for by that ticker. Select futures, and then you just select the month that you want, December 2023. The Fed funds futures are simple. They expire on the last day of the month for which they're named. So notice January 31st, February 28th, March 31st, April 28th, etc. ZT, T for the 2 years, ZF, F for the 5 years, ZN, N for the 10 year, and ZB, B for the 30 year. I'm not quite sure where the B is there, but I'm sure that's the long bond. B, right? Commenting on VIX calls versus SPY puts, these aren't the same. A VIX call is closer to a SPY straddle than a SPY put option, as VIX can rise due to two-sided risk, not just downside risk. Well, if we think about correlation, and as we move closer to a correlation of +1, we have perfect replication, meaning we do have the same thing, then we do have to say that a VIX call is closer to a SPY put than a SPY straddle. And that is because the VIX measures implied volatility on the index, SPX. And an index rarely smiles. By smile, I mean shows skew that looks like this. Indexes typically have skew that looks like this. And if you extend the calls out far enough, because there's a lack of bid and ask, so you get far enough out where you have bid 5, ask 10, the implied volatility has to be so high to make it that by the time you get out there, you start to see this on the index, but the cutoff for the calls being used to measure VIX would be about here, because most of these would have no bids. So because the index rarely smiles, it is not true that a VIX call is closer to a SPY straddle. It is closer to a put. Now, you could technically make the argument that since it uses both puts and calls, it can capture any upside risk because of call buying. Sure, you could make that argument in a very technical sense. Practically, however, smiles almost never happen at the level of the index. Okay, first question is here on this screen. Agency is investing long-term and financing short-term. Spread between long-term and short-term is their profit. No. For agency, that's not the case. The spread between the MBS and most closely the 10-year is their profit. So think about the spread on an MBS. This is the risk-free rate that is from your treasury curve, and this is the spread. That's what they play. They play the spread and they lever it up. If you go through agencies' statements, and if you've been through the agency video that I have up in the applied series, I show you how they hedge out this particular aspect so that they are actually playing this. This is the one thing they don't hedge out. They play this, and then depending on their view on rates, they'll either overhedge interest rates or they'll underhedge to protect both their financing costs. They'll use swaps, interest rate swaps, to turn their fixed rate borrowings into, their floating rate borrowings into fixed rates, and they'll use treasury futures. They'll go long treasury futures to hedge out any downside risk associated with interest rate risk. So no, it has nothing to do with the spread between long-term and short-term. It has to do with the spread between treasuries and the MBS. What do you think about Russian stocks right now? Not even thinking about that, nor would I think about that. There are easier fights to win. I think they're really undervalued relative to fundamental value. I live in Russia, so it's not safe for me to hold any Western stocks, and other stocks available here do not really impress me. Well, then you have limited choice. You have one market that you have to look at. I don't know what to say on that one. I wouldn't touch. I wouldn't touch it only because I know nothing about it, and it, it's a level of trust, right? Would I even trust some of the numbers coming out of Russian-owned companies? I don't know if I would at this point. Much as would you trust numbers coming out of Chinese-based companies? I don't know. But I think trust is a big issue right now. I just I know that this is all you have available to go on, so I guess you'll have to make the most of it. But I wouldn't have an opinion for you. I include the question rather than ignore it, because I don't want to just ignore it because you think, oh, he's just ignoring my question. I include it, and my answer is I have no clue. That one I'm going to have to leave you on your own for. What's your case on gold? I don't really have a case on gold. Never bothered playing gold. Never interested in gold. Gold never seemed to do what it was supposed to do when it was supposed to do it. I keep hearing gold bugs calling for 3,000 an ounce, 5,000 an ounce. Been doing it for 10, 15 years now. All this money printing will lead to inflation, and you'll see gold will be 5,000 an ounce. Well, we had lots of money printing and lots of inflation. If gold was going to have its day, I don't know what else you could do. I mean, you basically pulled out the chair for gold and said, please have a seat, and gold didn't sit down. So, I don't know. It seems more sensitive than usual to rates. I don't think it's sensitive to rates. And what the Fed will do, market perceives Fed pivot, gold goes green. I think the market perceives the Fed pivot, the US dollar drops, gold goes green. Is it rates going down, DXY? It is the DXY because gold is priced in US dollars. So if US dollars are very strong, you don't need that many of them to get an ounce of gold. And if US dollars are really weak, well, the price of gold will go up because you'll need more of those weaker dollars to buy the same ounce of gold. It's pretty much almost all commodities if you watch the US dollar, unless there's some fundamental issue with the commodity itself. But even looking at copper and platinum, palladium, things like this, whenever the US dollar drops, copper prices go up, because copper is priced globally in US dollars. A lot of international trade in commodities is priced in US dollars. So the lower the value of the DXY, the lower the value of the US dollar, the higher the price in dollars the commodities go, because a pound of copper is worth so many US dollars, but if the dollar's cheaper, then you need more of those dollars to get the same pound of copper. Okay, on Bloomberg lately, there has been talk about a potential liquidity crisis due to QT and restrictive government regulation, which limits the amount of cash banks can lend out. I don't know what to call that a government regulation. That's just a banking regulation. Limit the amount of cash banks can lend out. Do you believe that this issue may eventually occur? Well, may eventually occur. Here's a timeline. Yeah. When? I don't know. So, will there be a liquidity crisis? Sure. When? Not a clue. 5 years from now? 3 months from now? 15 years from now? But you're not asking for a time. You're saying, do you think it may eventually occur? Yeah, it'll eventually occur. Do I think there'll be a nuclear accident that will eventually occur in the world? Yeah, I believe that'll eventually occur. I like those questions when I'm just asked, will this occur? Yeah, I don't have to give a time frame. Listen, if there was an issue, you'd find it in the minutes of the Fed. They'd be all over that. And in the last set of minutes for the Fed, they note that the Treasury market is functioning without stresses. So if there was going to be an issue, the Fed would be all over it. I'd get it out of the minutes, and there was nothing there. I'm not seeing any liquidity crisis at all. So I'd say no on that one. I did read the Goldman Sachs U.S. macro outlook for 2023 from November 18th, in which they expect a rather soft landing for the U.S. and place a 35% probability on a recession, which is quite below market expectations. It is. They expect strong consumer spending. I expect that too. I mean, you'll still have strong consumer spending. When they say strong, they must mean in nominal terms, because I don't know if they mean in real terms, but in nominal terms, the American consumer has always shown itself willing to spend almost every penny it makes. You can always count on that, is their propensity to spend money as they make it. The more they make, the more they spend. Reduced labor demand. Well, as wages go up, you're going to have reduced labor demand over time, because you'll get to a point where, look, it just doesn't make any sense to add the next employee. Slower wage growth. Well, if you get reduced labor demand, you'll get slower wage growth. Although this I would say, I think you'll get reduced labor demand only because at some point you get tired of saying, okay, well, we can't hire anyone. Let's find a way around the problem. But you do have a labor force with a group that's exiting that's bigger than the group that's entering. So the labor force participation rate, I think, will continue to drop structurally over the next few years. So even if you get reduced labor demand, you also have reduced employees. I don't know that will grant you the slack that you need without a recession and declining inflation. They're basically describing the conditions for a soft landing, saying, if you continue with strong consumer spending, you get reduced labor demand, which slows wage growth, which helps to decline inflation, you could get a soft landing. Sure, 35% is not much above the 30% year-to-year probability of a recession. Empirically, there's about a 30% probability of a recession in any one given year. So 35 is just not much above that. So, I haven't read the report. If all the sentences start with that really, really big English word, if consumer spending remains strong and we see reduced labor demand with slower wage growth and declining inflation, we could have a soft landing. And maybe they place 35% probability on that, but it may start with an if as opposed to an actual statement. Well, I guess I disagree on that one. So we'll see. I guess we'll see. Can you explain the logic behind gaps filling? Nope. I have no idea why that's a thing. It is just a belief. It is one of those empirical observations that if you look at any chart that has gaps, they are eventually filled. And I don't know that there's any real good theoretical reason other than they just are. We've always seen them being filled, so we just assume they always get filled. We don't know why, but if somebody starts believing it, and a large enough group of people believe that gaps get filled and you're $2 away from a gap, there might be less inclination to sell or to buy until the gap is filled, and then the orders come in, right? So I don't know the logic behind it. What's the paper you mentioned on yield curve inversion? I don't know on this one, because I spent a day and a half just, clicking from link to link, reading different, I don't read entire papers. A lot of times you can get a lot from just the opening a few paragraphs, and then you can run to the conclusions and just see what's there. So if I were making notes for an academic paper, then you keep all your sources on a separate page so that you know exactly where everything was. But I'm not doing that. I'm just reading to answer a question in my head. So I wasn't really paying attention to sources, but I'm pretty sure it was one of the Federal Reserve sites, because every time you click on a link for one of those in one of the sources that they use, it brings you to another paper somewhere on their site or at another Fed site. So It was on some Fed site, I believe, but I don't track that stuff like as well as I should track that stuff. You mentioned on the steepener trade, on 2's trade, how would I be able to derive the ratio since the futures of the individual leg is of different convexity? If you're using futures, it's probably going to be difficult. The underlying of the futures is 100,000. You have to pay attention not to the futures but to the cheapest to deliver and what the duration of that is. And because they're indivisible at 100,000, it's going to be a rather large trade for you. Typically, when you're doing steepeners, you're going to use, well, probably the individual bonds, or you would use some derivative on each bond. I wouldn't try playing it with the futures. If you've never done a steepener trade before, I just wouldn't do it. That would be my suggestion. If you have traded deeply in fixed income for a while, you should be knowledgeable on how to construct a duration neutral trade. That you're asking would suggest that you probably haven't done a steepener before, so I would just avoid it. For your comments around market priced in the Fed for lower and shorter, could they be driven by the technicals? What technicals? I guess would be my question is, what technicals would move an entire curve? So I'm most likely apt to say no on that one. What is your take on the recent drop in the reverse repurchase facility from 2.4 trillion to 2 trillion? That is effectively 400 billion of liquidity that money market funds have injected into the system. Probably via 1 month and 3 month T-bills. And counteracting all the QT done so far by the Fed. No, that's not quite how that works. And I don't think that the Fed is actually calling it QT as much as they're calling it balance sheet runoff. No wonder markets are rallying. So you probably want to pay attention to something other than what the Fed is doing with the balance sheet, because that's not what's going on here. So because you have lots of volatility in rates, banks that need to park money overnight, and only some money market funds, not all of them, banks that need to park money overnight need something with zero interest rate risk. Because you have such high volatility on the short end of the curve, they need zero interest rate risk, which means they want to buy a one-day T-bill. Well, one-day T-bills don't exist. And if they were left to go to the market and try to lend their money out, they would drive interest rates down, because no one would really be wanting to pay that much, because every bank has an excess of funds. So the target rate is 3.75 to 4. And what the Fed does is it tries to keep the effective federal funds rate within that range by saying, don't lend your money for less than 3.75, we'll give you 3.75. So that becomes the amount that the banks can get. Because if that wasn't there, well, they'd say, look, 3.5% is better than nothing. And then another bank would say, well, I'll take 3.4, then there'd be 3.3. And with all that excess fund trying to find a home, eventually the interest rate would be driven down, and which would lower the effective federal funds rate. So the Fed is rolling off its balance sheet. Some of that roll-off is in T-bills, right? The 30-day T-bill is where a lot of money would like to be. Instead of getting the 3.75, it can get a higher rate, but it just can't live with this volatility. Not only that, there's a shortage. So even if they wanted to, there just isn't enough of them available. As the Fed is releasing these T-bills back into the market, it is reducing pressure on the reverse repo facility, because banks with volatility dropping on yields, banks can then go into the market and buy the 30-day treasury or a 15-day treasury, which is a 30-day treasury with only 15 days left, because they're now more plentiful than they used to be. So they don't necessarily need the Fed to get 3.75 when they can get the 30-day rate, which as of last Friday was 3.91. It was a drop of 25 basis points. Remember, I made a big deal about that, of why the 1-month rate is dropping. It should be moving. By the 14th, we should see it at 4.5. The 1-month rate should be at 4.5. That's probably that. Well, not probably. That's what's going on. Not that money market funds are injecting money into the system. So, do you plan to add to the applied series how to trade fixed income? Not really. Other than in the top-down section. We make the decision based on what the economy looks like, based on what things look like from a top-down perspective. We decide on what asset classes we want to be in, whether we want fixed income exposure, equity exposure, and that's about it. As far as going deep into the treasuries, the different bonds, the different trades you can get involved in, depending on what you expect volatility to do, what you expect the shape of the curve to do, getting into credits and analyzing individual bonds for their credit spreads, how to isolate credit, all of that for a retail trader is probably not really worth it. I think that you can probably get all the exposure you want either through an ETF that tracks a particular category or using interest rate derivatives. So, and when I do the futures section, I will be introducing derivatives, the fixed income derivatives, and how you can get exposure to fixed income through interest rate derivatives, mostly just the futures. But individual bonds, especially once you get into corporate bonds, as soon as you move away from the really liquid investment grade ones, they're all illiquid and pretty much not available unless you know what you're doing. You can get into a lot of trouble. So for the retail investor, stick with ETFs, and if you want to get a little bit more, clever, you can move into the futures. The futures market. First question, can you please show us how to use the Montreal Exchange implied probabilities data for Canadian policy rate? There are single probabilities posted for a specific move and no data for the other moves. Here's my answer. Not a clue. I looked at it and I can't make heads or tails of it. I tried, different interpretations saying, well, maybe it means this, maybe, I don't know. And the example they give about how to interpret it, I read it going, yeah, but it doesn't make any sense that, to get a move like that, you have to first assume that the rate had to go even higher first before it comes down. Do I have to read the curve in order and price all the moves? Made no sense to me. I have no clue. I don't really trade the Canadian market that much in terms of interest rate moves, or it just doesn't move very much, so I'm not that interested. But that is a head scratcher. You think they could have made it simpler, but they didn't, and their explanation doesn't explain a damn thing. Why 3-month 10-year inversion only happens in low growth environments? What's the rationale behind it? Because the short end of the curve will price in expected monetary policy. The longer end of the curve prices in future expectations of both growth and inflation. So if we are in a low growth environment and we are pricing in that the future will have lower growth, that's where you get the inversion. But if you're in a high growth environment and you're pricing in the future having lower growth, the 2 to 10 may invert, but the 3 to 10 may not invert. Let's see. JPM 2023 long-term capital market LTCMA report says it might be a good opportunity for long-term investors in equities and bonds. Do you agree? And how do you see those opportunities in 2023? Well, it's saying it's a good opportunity for long-term investors. I didn't read it, so whenever I hear anybody say it's a great entry point for long-term investors, I think, well, yeah, any point is a good point for a long-term investor. If you got 10 years, no matter what you buy, in 10 years it's going to be higher. Any point is a good entry for long-term investors. If you buy a house right now, that's a great entry point for a long-term investor, right? So how long is long term? And it is true any day of the year throughout history that has been true. If you're a long-term investor, now's a great entry point. So when you say starting from lower valuations, well, yeah, that's a duh statement, right? Hey, buy low, sell high, right? That's how long has that been around for? So, I didn't read it, but it seems like obvious statements to me. But if you're not a long-term investor, if your holding period is 6 months or 12 months, or you hate drawdowns. Drawdowns is you start with 100K, you say, I'm a long-term investor, so you buy 100K and you want to go down to 60K. How do you feel? Are you going to bail and take that $40,000 loss and forget that, hey, wait a minute, I thought I was a long-term investor? So it's you could say we're here and in 10 years we'll be here. But the path may do this, right? Can you live through that? That's the big problem. So you can have a plan, but sticking to the plan is another thing. I don't know if I agree with that. I think for bonds, it makes a lot of sense if you're taking a 12 to 18 month horizon, because somewhere in those 12 to 18 months, given the curve inversions we have, something somewhere is going to break, which will cause the economy to require lower rates. As far as equities, whatever breaks will also break equities. So the question always is, sure, any point is a good point for a long-term investor, but is there a better point for a long-term investor? If it's saying that sometime in 2023 this opportunity will present itself, yeah, probably. I think that's right. But is now the time to buy and hold and forget about it? I don't know. I think you could probably get better valuations in the next quarter or two. Last one. I was honestly consoled by your interpretation of Jay Powell's speech. I saw very little positive in it, and the degree of verbal hedging going on there made me think it could at best be interpreted as very, very tentative, uncertain. I think what he was doing in that speech was also preparing statements or priming the political scene for statements that he's going to have to make when he's called in front of Congress. And politicians want to grandstand for the camera by dictating that he should care about the economy. So I think he's just getting, trying to throw some of that stuff out there. I thought I was losing my mind when things rocketed up post-speech and held on to it at the Friday close. I was on the fence about buying VIX calls, thinking that this has to be just no overreaction, but in the wrong direction too. Now here we are on Monday, and I'm holding an empty sack because I didn't trust my interpretation of the situation and make the trade. How do you arrive at a level of conviction that has you pull the trigger on your positions? I was worried there was something critical I just didn't know. Loss aversion, which is very common as you get older. As you've incurred losses in the past, it is common to become more and more loss averse. How do I arrive at a level of conviction? I have a process, and I go. Everything goes through a process. So if I hear something that somebody says, this is an interesting stock, well, I'll make a note of it, but I'm certainly not going to buy it. That stock has to go through my process. And in that process, I ask what conditions would be the best conditions for this stock? And do we have those conditions now? And if the answer to that question is yes, we have those conditions now, then I do not buy. Because if we have those conditions now, it's already in the stock. Whatever the conditions are the conditions that I expect is going to happen. That this will happen in the next quarter or 2 quarters. That's what I want to buy. I want to buy something where the conditions are not right for it now, but will be right for it, and it's just around the corner. And everything has to go through that process. You see what I do every Sunday. I put it on video, but I've always done that for myself. I always go through my checklist, and I think deeply about it, and then I, by Monday morning, I'm ready to make my moves. It's difficult to trade in the moment sometimes because you get caught up in the frenzy of it. As far as loss aversion, usually retail investors, when they start out their career, have the opposite of this. They have regret aversion. In other words, they're afraid of missing out on something. So when they hear, oh, this is a good stock, they buy it without thinking because, well, what if it moves? And I heard about it and I didn't do anything. So they tend to jump on a whole bunch of things without thinking about the level of risk that they're taking on, until they get hit a few times and they start losing. Quite a few investors at that point just simply go away, but there's a group that will put more money in and put more money in. And when you play that way, with regret aversion, when you buy the hot names and you blow up again and again, eventually you get to the point where you're afraid to do anything because all you can remember is losing. So you end up being afraid, even though you've now gained all this experience and you should be better, you're scarred and you're afraid to pull the trigger. So I would say, have some rules by which you trade by, which is your business plan. You have your business plan for what you're going to do. You have rules to trade by. You have position sizes you won't exceed. And as long as it goes through your process, through your thinking, and while you're thinking, it's always better to think when the market's closed, so that you're not looking at every tick on the screen and being pulled in one direction or another. Wait till the end of the day. If there is an opportunity there, it's not going to disappear in 3 minutes. If it is the kind of opportunity that's going to disappear in 3 minutes, that's not an opportunity. Opportunities are something that hang around for a week, 2 weeks, a quarter, 2 quarters, maybe a year. So you're not going to miss much. Wait till the end of the day and then think it through. Go through a process, go through your steps, think it through very clearly. If you have some credible sources that you listen to those credible sources and see what they're thinking and see what they're saying. And then, make your decision. For the most part, if you're thinking about futures and things and currencies, those trade all through the night. So, if you make your mind up that, nope, I do want to be short the market, I'll short 500 shares of SPY in the morning, you may as well just sell one mini futures contract because it's equivalent to 500 shares. So I would say for this one, process. Make sure it goes through your process first, and if it does, take a position. If you are to the point where you only want to win, that you never ever want to lose, you're never going to be successful at this because you're going to have losses. But if your losses are small enough, your position sizes are never so big that one loss takes you down, you'll be okay. I have a question about synthetic positions via options. Put call parity principle says owning long stock is pretty much equivalent to going long and at the money call and short at the money put plus long bond. It doesn't even have to be at the money as long as they're at the same strike price. If you buy a call and sell a put at the same strike price, you have a synthetic. Just some synthetics you'd have to pay for, some would pay you, some would be debit, some would be credit trades as opposed to close to zero. Plus long a bond to account for the risk-free interest rate, as we know, is baked into the option price. Yeah. Is there any particular scenario where it's worth choosing the complexity of owning a synthetic over simply owning the underlying stock directly? For the sake of full analysis, let's imagine that the underlying stock gives out a decent dividend. If you're getting a dividend It depends on what kind of dividend you're getting. Is it qualified or unqualified? If it's unqualified, meaning it does not qualify for preferential tax treatment, you'd rather have a capital gain. And by using a synthetic, since the dividend is, if you have a full synthetic, the present value of the continuously compounded dividend yield is in the price of the option, so that you are getting that. So you're getting the present value of the continuously compounded dividend yield within there. So you turn a dividend into a cap gain. Where the synthetic has a lot of value is if you have a border. I'm in Canada and I want US stocks, but I want them in my taxable account. Well, there's no tax treaty between the US and Canada for a taxable account, only a registered account, and only a retirement account, not a tax-free account. So I lose, especially on REITs, I'd lose 30% of the dividend. Well, that's a lot. I don't want to lose that. Also, I have US dollar exposure. Maybe I don't want US dollar exposure. So by using a synthetic, I can get very close to it, to paying almost zero for the synthetic. My Canadian securities, my Canadian dollars in my account will act as collateral or as margin against whatever I need for margin. I now have full cap gains, and I have zero US dollar exposure except for the gain in the synthetic as it goes on. But I don't have the capital that is in US dollars, so I have no forex risk on the capital. I have no taxable income that the US government can take 30% of, and I don't have to pay any dividend tax on that income coming in, because it would be taxed as ordinary income, which has a 53% tax. So you're taking $100. If I held the shares, the US would say, we keep 30, you get 70, and then my government would say, oh, you only get 47% of that 70. Suddenly, it's not such a great dividend anymore. I'm getting what, $32 from the starting point of 100, but if I use the synthetic, I get the present value of the full $100. The U.S. government is unaware that the dividend is smuggled into the price of the options. The Canadian government is unaware that it's there and treats the gain as a capital gain, treats the option as a capital gain. I have questions regarding the use of the Treasury's issuance bid to cover ratio. In the last few months, Treasury issuance has dropped because tax receipts have been at an all-time high thanks to inflation. That's the nice thing about inflation. You can inflate that debt away, right? Assuming that inflation is receding and we might be headed for a recession, in theory, said tax receipts should decrease, driving Treasury issuance back up. It could, but keep in mind that wages have all increased, right? In a recession, those wages don't give back, so even though tax rates haven't increased, the tax revenues have increased because everybody's wages has increased. So yeah, you'll have some unemployment, but even that fallback in tax revenue is still more, probably would end up more than what it was before you had all the wages inflate. If we assume central banks are not buying treasuries as much as they used to, well, that's a word there, right? Assume that we must fully rely on private and institutional investors to pick up the bill, or else yields on the long end of the curve would rise again. If you have the market dropping, you will have a run to safety, which is in treasuries. So you'll have money just flowing into treasuries anyways. How could we effectively use the Treasury issuance bid to cover to analyze whether private and institutional investors are indeed stepping in? You just have to watch the bid to cover ratio. The economic calendar has on it, the economic calendar I use at Daily FX has on it all the issuance every week of T-bills and bonds. So you can, at those particular times, go to the Treasury and they'll report to you what the bid to cover ratio was for each one. So you can see it each and every time. I don't know that would be a problem. If we did have a recession, I would seem to think that the Fed may, I doubt it, but they may just halt the balance sheet runoff. They might not buy more bonds. It depends on how bad it is and what caused the recession, but they may halt it. But the big thing is that whenever this happens, there is always a run to safety from around the globe, and the safest asset out there are U.S. Treasuries. What is the difference between bonds and CD from a retail investor's perspective? What are the pros and cons for investing in bonds versus CDs? I'll be straight with you. I know very little about CDs. I believe that they have what's called an add-on rate. Bonds have a coupon. So every 6 months you get a coupon, you can buy more bonds. Whereas the CD, whether it's marketable or not, if it's a marketable CD, then you can buy and sell it in the market. But if it's not, then you're locked in for whether it be 1 year. I don't know what years CDs come in. I just don't know a lot about CDs at all. I think bonds give you more flexibility than what a CD would, but I could be wrong on that. So I'll leave that one to you. Or if somebody knows something about CDs, please go ahead and answer. But this seems more of a bank retail product, and I've just never been on that side. Question regarding curve steepener trade. Is that on bonds, I assume, and not on the yield? It's the same thing. I mean, a bond has a yield, right? It's the same thing. You expect short-term rates to decrease faster than long because of the recession, causing short-term bonds to rally more than long-term bonds? Well, not quite. A steepener trade is duration neutral. So you may, if you're looking at an inverted curve that looks like this, what you're expecting is this part of the curve to drop and this part of the curve to drop a little bit, so that you end up with an upward sloping curve like this, just all at lower levels. So to be duration neutral, because this has a much higher duration, you may have, it may be that you have 80,000 short on the long end, or 80,000 long on the short end, 20,000 short on the long end. You're just playing the change in the slope of the curve. You're just isolating that move, and you're isolated by being duration neutral. You are isolating changes in levels of rates. You're playing the shape of the curve. If you've never done a curve steepener trade, don't do it. I know that there are some people who watch the Market Outlook who are, CFA charter holders, CFA level 3 graduates that understand what that means by a steepener trade. So they're in a position to say, oh, I know how to get that done. If you've never done a steepener trade, or don't know how to do a duration neutral trade, or have never done anything like this, just avoid it. Just don't do it. Regarding the TLT trade, I've also initiated a position a couple of weeks ago. So very glad to hear your thoughts on it. What do you think of the chances the current unexpected rate hikes do not slow both inflation and growth enough, and for there to end up being a much higher level of rates than currently anticipated? My understanding is that this is very unlikely, but would basically be the only scenario in which a TLT trade doesn't work out. Is that correct? Well, even if the only condition under which the TLT trade wouldn't work out is not quite that. It is if the Fed cut rates too early. If the Fed cut rates too early, the market would start pricing in higher inflation expectations into the long end of the curve, and you would then get a steepener by the long end of the curve rising. If inflation doesn't slow down and they keep hiking rates, you'll get a more inverted curve, because the higher rates go, the stronger the expectation that a recession is going to follow, because you'll be choking off a lot of economic activity. You'll be raising the cost of capital. You'll pretty much eliminate or wipe out business investment, residential fixed investment, autos, cars. You'll make the cost of credit so expensive, there'll be major pullbacks. So that if inflation wasn't coming down and we had the idea the Fed was going to raise rates even higher, I think you would not get a significant increase on the long end of the curve as much as you'd get a deeper inversion. implying that there's an even greater belief that we're going to get a recession. So I think the only big scenario that I can think of in which that trade doesn't work out is the Fed cuts too early and inflation still hangs around. They've made it very clear that they're not about to do that, so I wouldn't worry too much about that. Whenever you put on a trade doesn't mean it's going to work out. You have to think about, well, maybe it doesn't work out. So what I suggested in the video, I suggested buying calls, right? Go out to January 24 of 2024 and buy the 115 calls. I picked those up for $6.50. You should have been able to get them for in around that price. And here is what we do, or what the trade would look like. Is you're out $6.50 or you're out $650, and that's what you have risked to make that trade work. At some point, you want to pay for this. You want to be money neutral. So you wait. And if the 30-year yield keeps going down because of deeper curve inversion and greater recession expectations, well, these will start paying off. They'll be in the money, and, well, I shouldn't say in the money, but your position will be in profit. The option won't be in the money until TLT rises above 115, but you'll be making money. And if there is a recession and rates get cut, then the 30 years should do very well. Or the 20 years, sorry, the TLT is based on the 20 year. The 20 year will do very well. But let's say, where did we end today? 106 to 107, somewhere here. Let's say that this does happen. Is the market loses confidence in the Fed and thinks, your rate hikes aren't really going to do it, and starts pricing in inflation expectations into the long end of the curve, and TLT drops, and you see it drop to 100 and then 98. Well, great. I mean, if it's at 98, you'll go out to January 2024, you'll look for a put that's priced at 650. That might be at 90. So you'll sell the 90 puts. Well, if they keep raising rates and the price of TLT drops, at some point this is going to break the economy. Owning it at 90 is not a bad deal. Now you're selling it at 90, so you're going to get 650. So you spent 650 on the calls. You're going to get 650 on the puts by waiting. You're stepping into this trade. This is now called a risk reversal, right? Short the put, long the call, and then you wait. If it goes up and goes above 115, you make money. If it lands somewhere or stays somewhere between 90 and 115, you don't lose a single penny. And if it drops below 90, well, you'll own it at 90, but great, you own it at 90. That's not a bad deal, right? So this is part of what's called a trade plan. So you never, I shouldn't say you never. I never say I'm going to buy. And that's it. And that's my plan, is to buy. It's, well, how am I going to get in? Am I getting in quarters? Am I getting in thirds? Am I taking a tenth of a position just to taste it? Am I getting a half position? What am I doing? At what dollar value will I make another decision? What does my full position look like? What will I do if the price drops? What will I do if the price increases? So that I will then step into the next part of the trade, whatever that happens to be. So that is my plan. If I were just buying TLT at whatever price that is, that's a huge amount of capital to put out. Here I put out $650. That's it, right? But if I bought 100 shares of TLT at, let's say, 106, I got to put out $10,600. Well, that's a lot of US dollars to have at risk, because now I got Forex risk over here, and I got interest rate risk over here in the issue itself. But here is $650. And if the price goes up, I start winning. If the price goes down, not only will I be able to sell a put at a lower strike price than if I had sold a put when it was at 106, I'll get a lower strike price, which lowers my risk even more. And since I'm selling the put at a lower price, my overall margin requirement will be lower. But I'll get the added benefit of implied volatility increasing on the puts as the price of this drops. So maybe I might not get 90, maybe I might be able to go to 88 Or maybe I'll even be able to go to 85 with the higher implied volatility and sell there, right? That's my plan. Last paragraph here. Also, when I have looked at Fred time series of the 30-year yield, looks like for much of the time during the past 20 years it has been higher than where it is now. I was surprised that it wasn't lower than it was during the few years post GFC. How low would yields need to go for this trade to work out? That's the 30, right? Remember, the 20 has a funny kink in it. You have an inversion to the 10, the 20 does this, and then the 30 drops again. But I get your point. How would you go about setting a rough price target? How low would yields need to go for this trade to work out? Well, I don't know. Because you're buying a long-dated option, it's got a negative carry because theta is not your friend, right? But it's such a long period of time that theta decay is going to be almost minimal for the next 3-4 months. It'll be almost minimal. So you don't really need too much of a drop in yields for the trade to work out, unless you plan to hold it all the way till expiration. How would you go about setting a rough price target? And there, I don't know either. My price target depends on what unfolds. I could be holding it at $6.50, see it go all the way to $9, and then think, things aren't looking good. I'm seeing volatility start to tick up. I'm seeing signs on the horizon. Let me exit. That's not a bad return. $2.50 or $250 on a $650 investment for whatever period of time I held it. I might exit at that point, or I might say, this is everything is working out in my favor. The economy is falling apart. The Fed is going to have to cut rates by 150 basis points. Let me buy more at 9. I might lean into it. So I don't. It's way too early for me to determine what my exit is. Okay, you mentioned that economic shocks happen all the time, and they send high growth regimes into low growth regimes, low growth into recession. Could you provide a few examples of shocks in the past decade, maybe common types of shocks? Okay, so a good one was, I believe, 2012. We're 2 years into the recovery, and you had the Greece issue, the Greek debt issue, that just kept arising and arising, and there were, financial summits every 3 weeks held by the European Union, and we were 13 weeks in, and it was that day where you saw the riots and the protests in Greece, and the tensions were rising and rising. That didn't cause a recession, but that was an external shock. Go back to 98, the Thai baht, which caused a little bit of a pullback in the markets at that time, but didn't cause a recession. So it's hard to identify these things that don't cause recessions because they don't cause recessions. They just cause some concern. So all you have to do is you look at a time series of the S&P, and you'll see it do this, and then every now and then you'll see it do something like this. It'll do something like this. Well, there's something going on that caused that. That there was some concern or some fear or something going on that caused it. So just look for those events, look for that period of time, whatever time span that was, and what was going on at the time. Common types of shocks that do this. Usually it's either credit or financial related, or it's geopolitical. And geopolitical, you're really talking about conflicts. War breaking out, or potential, trade war looming between two big enough economies, or a particular natural resource that suddenly is off the market for some reason. So those are fairly common. I remember you mentioning one of the most tax advantageous strategies is buying REITs in a tax-exempt account. BDCs, business development companies, also distribute some distribute 90% of their income to avoid taxes. Not all of them, some. So you better be sure when you're picking up one if it does do that. What are your thoughts on BDCs, and what are some of the key metrics to look at when screening them? I don't know about the key metrics to screening them. One of the things you'll notice very quickly about these things is the low level of volatility that they have. They have a decent enough yield, but very low volatility, which you can usually get with a bank preferred share or a utility preferred share as well. You can get that kind of low volatility with the higher yield. Even preferred shares of some REITs. Some REITs issue preferred shares which have, a nice dividend on them and have that low level of volatility. With a REIT, they invest in illiquid assets, which is real estate, but you can value the real estate because any commercial real estate is worth the present value of its future cash flows. So you can come up with some estimate of fair value. So you can come up with an estimate for NAV. The investments in BDCs, either private equity or private credit, they're much more difficult to, especially the equities, much more difficult to come up with a fair value estimate. So the NAV that it arrives at is really, okay, so you say that it's worth this. Is it though? Whereas with real estate, you can look at it and you could say, well, does it make sense for you to value that property at this level? There are other transactions that occur in the market that you could look at as a good litmus test and say, okay, well, you're not too far out of range. But because of that, because they can value it, they tend to have very low volatility. I've never really evaluated one, only because it seems more of almost an income play as opposed to a capital gain play. They don't really have a lot of upside, nor do they have a lot of downside. And if it's the low volatility and the yield you want, you can get that with good preferred shares. You can get that with an investment grade, even stepping down to triple B investment grade corporates. You can get that with some bonds that I don't know that you need to go into BDCs to get that. Is there a certain reason why you choose the simple moving average versus the exponential moving average? Well, the simple moving average is meant to, if you have a stock that's moving like this over time, right? So that's kind of hard to see, what's going on. We have an idea that we have a downward trend, but the idea behind the simple moving average is meant to smooth out that trend. Well, that is the simple moving average that's doing that. If you have an exponential moving average, it's heavier. There's a heavier weighting to more recent events. Yeah, that may be useful if you have a stock that's doing this kind of thing. That's moving up like this, so that your speed lines are doing this all the time. Well, if you're using a moving average, a simple moving average, it may start to look like this, where the distance between the moving average is a little too much, that you might want an exponential moving average that gets pulled up with the sort of sharp upward moves that's happening. But over a period of time, especially at the level of an index, I think simple moving averages are really what everyone uses, simply because it's meant to smooth out the longer term trend. Just wondering if you can bring in the incredibly fast pace of savings depletion of the U.S. consumer. Well, you're using an adjective here, and I haven't verified whether that adjective is true or not. Let's say that you're using two here. The pace of savings depletion of the U.S. consumer and the increase of credit card balances. It's not increasing that much. Credit is increasing, but increasing at a slower rate. If you look at the consumer credit report issued by the New York Fed, it's not that much. In fact, they say that even though credit card balances have increased, they still remain below their pre-pandemic levels. When you look at how much is on credit cards now versus how much is authorized to be on credit cards, there's still a huge amount of capacity for borrowing on credit cards. Both data points on Fred. You don't need Fred. All of this you can find at the New York Fed, the consumer report, consumer credit report by the New York Fed. Really helpful because it also shows you credit scores by balance. So you can look at credit cards and you can look at what the average credit score is on it. What percentage are of this credit quality, what percentage are of this. And they do make a note of saying, at least this is the Q3 report for the third quarter, that even though delinquencies and delinquencies and defaults on credit cards have been inching up, they are at extremely low levels compared to pre-pandemic. As far as the savings being drawn down, we have wages doing this. You have wages that have been increasing, 5%, 6% year over year. So wages have been doing this. When we think about the ability to spend, you think in terms of stocks and flows, right? The stock of money you have is your savings. The flow of money you have is your income. It's your cash flow, right? So your incomes are increasing. This will always remain a source of spending power. There is a lot of room left on credit card balances. So that is available as well. From an investor perspective, we should not care in the medium term, medium 2-3 quarters, we should not care how the consumer comes up with money. All we should care about is the consumer willing to spend. If there was very little capacity left on credit cards and the average credit score of the weighted by balance was to the lower end of the spectrum, and you had delinquencies and defaults that were above a certain level, then we need to be concerned that might spill over into the economy. But our job is to make money off these people. What do we care where they get money from? What do we care if they're selling their grandmother's microwave and TV set to go spend money at the mall? As long as we own the stores that they're spending money at, what do we care? In the short, I know it sounds cold, but you have to think about that from an investor perspective. Is what do we care? All we really care about is how much money is available to be spent. What are aggregate incomes at? And aggregate incomes keep growing. As far as the stock of savings being drawn down, when the economy closed, money piled up in accounts because you couldn't spend it. So consumers paid down credit card balances. Had the economy been open, all of that would have been spent anyways. There would not have been that level of savings. So that level of savings really is just a mirage. That level of savings exists on credit cards right now, because you look at the chart. I'll just draw it out to show you what it looks like. Over a period of time, here's what the balances look like. But when they have another lighter line up here, which shows the amount that is authorized, looks like this. So this is how much is owed. This is how much could be owed, because these are the credit limits on credit cards. This is the aggregate amount of credit limit. This is the aggregate amount being used. This over here was the amount of savings that they had because they couldn't spend. It went on the credit card. So if they use their credit card, all they're doing is going to return it back to the level that it used to be in terms of what capacity they have. So this over here is where their savings are sitting. So if it shows that while bank balances have been declining, so have credit card balances. That's where the savings went to. Okay, trading question regarding time in force settings for brokerage orders. Should we set as day or good till canceled? My concern with GTC is, what if one day you set the order and the next day at open market gapped to what would have been a much more favorable price, but because you said a GTC you got filled at a less desirable price? That wouldn't happen. You have to get best price. So let's say that you have a buy order and you set your good till canceled limit for a buy order of 20 when the stock is at 21 and the market opens at 19. You'll execute at 19. It's not that you'd execute at 20. You'll execute at 19. So I wouldn't worry about that. But I don't know how many GTCs you'd have open at any one time that you couldn't manage them in pre-market. That you would look at what's going on in pre-market and you might reset your orders based on information. As long as you don't have your good till canceled order set in terms of fill outside of regular hours, meaning that it can be filled anywhere from 4 in the morning to 8 o'clock at night, because you can actually start trading some very liquid US stocks at 4 o'clock in the morning. Limited trading, but you can still trade it at 4 o'clock in the morning. That I would seem to think that you would be aware of what you have and that you could manage it. FX swaps and forwards, should these products be classified as debt? Call it a liability, not debt. It's not debt really. If so, why and why not? Currently they're treated as off-balance sheet items. That's not quite true. The derivatives in use, there is a disclosure for derivatives, and you have to list the derivative in terms of its asset value or its liability value on the balance sheet. So let's say you enter into an interest rate swap, and it's a 5-year swap with a fixed rate of, let's say, 2%. And interest rates have gone up and up and up, such that after a year you look at what a 4-year swap fixed rate would be, and a 4-year swap fixed rate is 4%. Well, this swap is going to have positive value. So on the balance sheet it would be listed as an asset. If, on the other hand, it was the other way around, you entered into an interest rate swap at 4%, and 2 years later, as interest rates dropped, the fixed rate was 2%, this has negative value, which means if you were going to exit this swap, you have to pay the other side the value of the swap at that point. Because it has negative value, you would have to list it as a liability. So they are listed on the balance sheets in terms of whether they are an asset or a liability, but it's not classified as a debt because you don't know that it's going to be a debt. For whatever derivative you have, how could you possibly list it as a debt when you don't know a value? It is rightly called a contingent liability. So on day one, when I enter into a futures contract, I have a contingent liability or a contingent asset. I will not know until the day is over. Then I'll know whether I have an asset or a liability. But then the next day may change that. So at quarter end, when I have to report it, I would report whether I have an unrealized asset or an unrealized liability based on whether I'm in a gain or I'm in a loss. Next question here. What was with the ES short position? Well, it just was more convenient to take a short position in the futures because I don't know how long I'm going to need to hold it for. And there is an upcoming dividend, I think next week, on the SPY. And if I'm short the SPY, I'm going to have to pay the dividend. Whereas it's already calculated within the ES. And the nice thing about the ES is, if you know anything about forwards, it is got because I'm short, I have a positive carry because it is the spot price increased over time by R minus Q, R being the interest rate over a 6-month period, because it was roughly 6 months out, minus whatever the continuously compounded dividend yield is multiplied by time. So if I'm long, I got a negative carry. If I'm short, I got a positive carry. It's hard to find anything long with a positive carry these days. I got a positive carry in a short position, so I have the interest rate in here. Why is it equal to 500 times? It's not 500 times S&P, it's 500 times SPY. And it's not 500 times SPY, it's 500 shares of SPY. SPX is the index, and there are options, futures contracts on the SPX, but this is for 250 times the index. They're big contracts. So every point move is $250. So if you're short and you get a stupid 100-point rally, there goes $25,000, right? ES is what's called the mini, and it is for 50 times the index. Well, SPY is 1/10 the index. So if ES is 50 times the index and SPY is 1/10 the index, to get this to 50 times, you would have to multiply that by 500, right? 500 divided by 10, the 10 comes out, you have 50. So 500 shares of SPY is roughly equivalent to being short or long one E-mini futures contract, but you don't have to worry about any dividend that happens to be due. And you have a certain time constraint as well, but if you're short with a upward sloping futures term structure and you're short, you do have a positive roll because of the interest rate factor. Why is it convex? Is because if the market goes up $1, I make $50. But if it goes down $1, I lose. Sorry, if it goes up $1, I lose $50. If it goes down $1, I make $50. If I have options, options are convex because the delta keeps changing. So if I'm long a call, let's say, and the market is going up, this is what my gain looks like. It's convex. But if the market goes down, my loss is not linear in this sense. It does this. So if this were 0 and I were long something, you have a linear relationship between gains and losses, but the call, you can only lose what you paid, so it's convex in this particular sense. So you don't have a linear relationship. Last one here, about last three, about inflation. What are your thoughts on the new normal narrative? Does it make any sense to you? Well, it makes sense. If it didn't make any sense, it would be a conspiracy theory and not really a conversation among intelligent people. So it does make sense that if you are tightening up the supply channel throughout by deglobalizing, the idea that you can reduce the elasticity of supply makes a lot of sense, that if demand increases, perhaps it will be the case that supply simply just can't increase the way it used to. That could be true. So it does make sense. Is it likely, even though it does make sense, is it likely? Well, I don't know. Well, that only time can tell. Doesn't make any sense. We have a situation where it isn't likely to see an increase in production from OPEC. Probably not. We have shortages in most of the raw materials. For the most part, I will agree with that, especially when it comes to materials related to the EV sector. Well, maybe not shortages now, but definitely shortages are on the horizon. If EV continues to grow the way it is, you're going to hit a wall of supply a big wall of supply shortages 2025, 2026, a big wall. And the housing market here, mostly labor. It seems that we have a deficit. Yeah, I think you're right, and I think that's why it'll take time for inflation to come down, unless you have a recession. You need to encourage more supply. You need low interest rates. You need low real rates. Because that encourages investment, and investment is the one thing you need to increase capacity. At high rates and very high real yields, it's hard to justify more investment. So if you want to create a bigger deficit in the housing market, keep raising rates. That's why I'm bullish on the housing sector, is because eventually you're going to cause a recession. Eventually rates are going to come back down, and demand for housing is going to come back right when there's no housing. So the home builders, look at the home builders. Toll Brothers reported earnings last night. Look at them today. Up 40, they were 46, now they're pushing $49. That's a big move on a home builder, and it's still only trading at 5 right now, 5.5 times their forward guidance for 2023 for EPS, $8 to $9. Their dividend payout ratio is like a measly 8%. They announced a stock buyback as well. All the home builders are just flush with cash, and that's not going to go away. And they all have major order books in terms of the houses that they have on order that they still have to build. Imagine if rates really dropped and the housing market started to come back in terms of the demand for housing, right? This is what high rates are doing. It's hollowing out a market now to create an even more aggressive market in the future. So I think you're right in this one here that maybe we will have a new normal. And if we look at how inflation came down throughout the 80s and the 90s, it took 20 years for inflation to come down from 7, 8, 9% a year all the way down to, I think we ended in the late 90s, 4 to 5%. It took that many years for it to come down. Now, mind you, we did not have technology during that period of time like we have today. So technology can drive costs down in a whole bunch of sectors of the economy, but when it comes to the real economy, and I mean real stuff, not bits and bytes, not the digital economy, but the real economy, yeah, I think there's going to be an issue there. About the earnings forecast for a company, I want to know if there's any source I could find some sort of template for this forecast. I just want to see how analysts come up with their numbers and growth rates. I don't care if it's outdated or old. Level 2 in the FRA section, the very last reading, takes you through an example of how you would build a cash flow forecast for a particular company, forecasting out its revenues, its cost of goods sold based on its relationship with revenues, and other expenses based on the relationship with revenues, different items on the balance sheet based on their relationships with revenues, and then from that your cash flow statement automatically builds itself. But that, if you're interested in that one, it's the last reading in FRA. If you're not a CFA candidate and you don't have access to that, I imagine you could just Google something like that, or if you have if you're on LinkedIn and you have a decent enough network that can pass your request along, just requests an old one, even if it's 3 years old, the people will be willing to share something. Especially if it's so out of date that it has no value, they'd be willing to share it. So you can come up with that just by using your network. About Edgar, it's a naive question. Which source should you use when you want to analyze a company's earnings report? Should you just get the PDF from their own site, or should you wait for them to upload it on Edgar and review it from there? I find for the retail investor, it's probably just as good to stay on the investor relations site, from the company, because they provide you with a bunch of really good presentations, and the report they give you compiles a bunch of data from past reports that you don't have to get yourself. For example, if you go through D.R. Horton's presentation, they show you the amount of homes they built every year over the last 20 years, and they show you what their market share was every year of new home construction and how it's built over time. Well, you'd have to go back through how many years of reports to find all of that little bit of information quarter by quarter by quarter to build it yourself. It's already done. However, what is uploaded to Edgar is SEC mandated. It is all of the notes and all of the details. You're probably not going to get all the notes and all the details and all the subtables from the PDF. It's meant for a very high level presentation of what they do. If you really want to do an analyst job and dig deep, you're going to want the filings on Edgar, because it has a lot more detail on almost every single line item on the balance sheet and on the income statement as to how it was built up. That is just simply not needed for an investor presentation. So there's, as an investor, there's certain information that you can get that's useful off the investor relations site. But if you're trying to do something more and dig deeper and forecast a line item out for the next 4 or 5 years, you're going to need a lot more granularity. There, I would head over to Edgar. As an investor, I wouldn't ignore Edgar, because there's a lot of extra detail in those notes that can highlight potential risk factors. Plus, the management discussion and analysis, item 7 on the disclosure, is sometimes very interesting on its own. Even for the annual report, the 10K, which is the annual report. It is the only audited report. The 10Qs are not audited. It is the only audited report, but they don't audit the management commentary. Now, they say they don't audit the management commentary, but having been through an audit for a publicly traded company before, they put on 2 pairs of glasses to read the management commentary to make sure you're not saying something that they absolutely disagree with. They want to make sure you're not offside. So while they don't audit it and verify it, they certainly use a bunch of eagle eyes on it. So, the idea that it's not audited we'll take with a grain of salt. Anyways, that'll wrap it up for this week.